Thank you everyone for joining us today for our March webinar. We're going to go ahead and get started. My name is Natalie Higgins and I'm General Counsel for the Equipment Dealers Association. I'm joined today by Bill Hill of Visor Benefits, and we're happy to have these folks lead us through the basics when it comes to tax and employee benefits planning at your dealership. Visor and Scheffel Boyle are both contributors to EDA's Compensation and Benefits Survey, which you order by visiting our website at www.news.equipmentdealer.org. The survey is a must-have resource for every dealership to help ensure that you're complying with applicable personnel laws and staying competitive with pay and benefit structures. Before we get started, I'd like to just run through some basic housekeeping. This and other webinars are a free service of the Equipment Dealers Association to our dealer members. The Equipment Dealers Association serves its members by advocating in Washington, D.C. and by providing industry relations services such as contract reviews. Here at EDA, we don't charge extra for webinars, but we are funded by dealer dues. So if you haven't done so already this year, we'd encourage you to renew your EDA membership and help ensure that EDA can continue to provide these valuable services. For today's webinar, we will take breaks to respond to questions. As we go through the slides, feel free to type in your questions. We will review those questions and either answer them live, or in the instance of a specific question, we may answer them via message or ask to follow up with you after the webinar. A link for the slides to the webinar recording will be emailed to you in case you'd like to review them later on or share them with others in your dealership. For EDA members, make sure you remember that you also have access to EDA's legal hotline if you do have follow-up questions. So that's all I have with respect to housekeeping, and so I will go ahead and turn it over to Bill.
Thank you, Natalie. And as soon as that
well, technical difficulties.
All right. And I want to, again, encourage everybody to ask questions, type them into Alex as we go through some of this information. And I want you all to know that I purposely created quite a few slides, so I'm going to move rather quickly. But the reason there are so many is that I wanted you to have some backup so that you could refer to, so that you could refer to a little bit later on. My firm here is located in St. Louis, and we have offices in Seattle as well. We do business nationally, so we're very familiar with all of the different jurisdictions and some of the rules that apply to different states. But most of our work now tends to be focused on compliance. And with all the recent regulation changes, it seems to be the area where most employers are weakest, and we try to help them navigate some of those compliance efforts to make sure their plans maintain their qualified status. This is an overview of some of the things we're going to be touching on today during our agenda here. And I'd like you all to know that a lot of the information that I'm going to be sharing with you comes from the government itself. These are two publications where I drew most of the information, and they're available from the Department of Labor. In fact, if you've never been to their website, I'd highly recommend it because you can get a lot of reference material that you may need for just daily operations, not only in your company, but also for your benefit programs that you offer. I'm going to start with what a plan is first. Everybody mistakenly thinks that whenever they buy an insurance plan, whether it be health, dental, disability, whatever it is, that is their plan. That in effect is not really your plan. It's an insurance program. But your plan is something that you implement, and because it is a plan, it has to have its own documentation. Most plans are organized, as far as the Department of Labor is concerned, most plans are organized in two separate manners. The first one is what we call a wrap, and that is that the plan is actually, in this case, the Acme Inc. Health and Welfare Plan. And within that plan, there are several insurance programs. The life, the medical, the dental, the vision, and it can include other things as well, like a prepaid legal program or voluntary benefits, AFLAC, things like that. But for the purpose of the government, this is one plan document. Then you have individual plans, and in this particular case, I've illustrated so that every insurance plan that's illustrated is its own plan. whether it's documented or not. And that's going to have implications I'm going to explain a little bit later. So what causes liability? And it says here that basically employers don't necessarily have to offer a plan, but once you do, you are subject. That's a big misconception because for the most part, the Department of Labor is not really paid attention to smaller firms. Once an employer creates a plan, employers who exercise discretion over the plan become fiduciaries and are personally responsible for plan operations. So what they're saying is that if you have the authority to make a decision on plan selection or plan operation, then you are a fiduciary of the plan. And as such, you can be held accountable for any bad decisions before the beneficiary of the, or for the benefit of the participants. And that's what the slide here basically goes to understand who is liable in a plan. A lot of times we run into situations where administrative assistants can be making decisions and they are unwittingly fiduciaries and financially responsible for any that are made about them. Generally speaking, ERISA notifications are required during an initial enrollment annually upon request. Excise and then listed all the notices. I'm not going to read them. They're in one of the booklets that I've given you that I pointed out earlier or identified earlier. So most employers aren't aware that these notifications actually are required. And in some cases, the insurance company, the health insurance company, will actually distribute some of these because it's part of their certificate. But please don't make the mistake of thinking that your responsibility distributing all these documents. There are going to be required notices, and those are not going to be the only ones. But a summary of material modification, a notice of material reduction in benefits, or a new SBC. The SBC you're probably familiar with because most insurance companies did send them out or at least made the clients aware. Again, that does not have. And then there's going to be annual reporting. Currently, Form 5500 has to be filed every year for certain plans. And right now, that just includes plans with more than 100 participants, and that when they say on the plan, and plans with fewer than 100 participants if the plan pays claims directly. So this is going to include HRAs or any reimbursement programs that you have. And I wanted to touch on this because the survey kind of gave some conflicting information. Some of the dealers stated that they had an HRA, and some stated that they reimbursed, and then some stated that they were self-funded, and none of those percentages of employers that were doing those things matched up. And the fact of the matter is that if you have an HRA or you're reimbursing any expenses, then you have a self-funded plan, regardless of your size. So that would incur the liability of filing that 5500 form. Next slide, sorry. And then the annual reporting, there's a Form 720 that has to be filed, and it is required for groups with self-funded plan. Again, going back to what I was just saying about the 5500, if you have an HRA or you reimburse any expenses for your employees, you have to file a Form 720 because you have a self-funded plan. And it must be filed before or with the corporate returns. Then there's going to be event filing. So the, Form 8928 is basically a tell on yourself form. So if you discover that you have failed to provide any of these listed notifications, then you basically, once you discover that you failed to give that information out or those notifications out, you have to fill out the 720. You have to correct the failure, and then file that 8928. If you do that, there's no penalties involved. If you don't do it within that 30 days, then there's going to be an excise tax that's charged to the company. How many 5500s do I have to file? So going back to the difference between the way plans are organized, if you have a wrap plan, then you only have to file one 5500 for all of the different insurance programs. However, if you have an if all of your plans are individually written and you do not have a wrap document, then you have to file a 5500 form for each plan. And each plan has to have its own summary plan description, and each plan has the requirement to distribute all the notices. So it makes a lot of sense if you're going, once you do the SPD, to do it in the form of a wrap document. This is some information I pulled recently from the Department of Labor's website. So one thing I should tell you that if you do all of the information that you supply the Department of Labor, the 5500 forms, if you are audited, all of that is public information and is freely available on the department's website. In this particular case, I wanted to illustrate an example of a reason why not to have individually written plans. So as you can see here, Navistar, right there in the middle, the chart, Navistar has all of those different plans: the disability income plan, the group life and AD&D plan, the health plan, the paid up life insurance plan. So they have all of those plans, and they have the requirements for completing an SPD, and all the notifications have to go out for each one of those, and they have to file a 5500 for each one of those. Well, down at the bottom, you'll notice, and it got cut off a little, it says Navistar Inc. Retiree Health Plan. So they have that health plan as well. Well, it seems that somebody must have forgotten to fill out the 5500 form, because if you look below that, that is a cutout from a spreadsheet of their enforcement actions. And what you'll see there is that on the second line, in 2010, they forgot to file the 5500. And then they didn't, every filing thereafter was delinquent. All the way to the right, you'll see the fines that were imposed for the failure and for all the delinquencies. They received a $10,000 to $50,000 fine for each one of those events, each one of those failures. So making a mistake like this can be quite expensive just for forgetting to file the forms. And this is a point I'd like to make. Most employers don't have a proper SPD. Their plan is not documented. If you receive information from an insurance company that says plan description or plan document, that is not your document. Anything you receive from an insurance company cannot be a plan document. A summary plan description is the main control document of every health and welfare plan written. Every SPD requires a separate 5500 form filing. This is a letter from a recent audit. The name's been blacked out to protect the innocent, but I say recent, it was 6 years ago. But if you go to the next slide there, within that letter, they detailed that the descriptions from the carrier are not the plan documents. They actually said our investigation also revealed the carrier documents are the only documents governing the plan. The plan does not provide an SPD. This failure is multifaceted, because not only were they relying on the plan document or the certificates from the carrier, but that means that each one of their separate insurance plans is its own plan. So they would have had to file, they would have to go back and file for all of those separate plans again, and each one of those individual plans can have its own fine. So it makes a lot of sense to get your plan document and do it in a wrap format. And the next few slides are going to illustrate, are going to illustrate that things are changing with the Department of Labor. With all the information that has been required from the government with the ACA, the department has decided that they need to collect that information. So there's been a lot of recent changes I'd like to make you aware of, because if you haven't gotten your plan documented yet, I would highly recommend you start investigating what you need to do in order to get that done. About a year ago, carriers across the country started changing their applications. Next slide. And this particular application is from United Healthcare. And if you look, the documents in the background, the actual page, the second page of the applications are on the back. This is the application the employer would fill out. But the thing to note is that the difference between 2015 and 2016 for groups that have 1 to 50 employees, and they're now asking whether or not your group is subject to ERISA. But then they go on to say most private employers are subject to ERISA. Why are they asking if most are subject to ERISA? And this is not just limited to United Healthcare. This is, I'm seeing the same question on Anthem's application, Primera's, you name the company, and they are asking about ERISA now. And so you start looking in what the department actually knows. The numbers at the top represent the number of businesses in the country. So if you just look at the businesses with 100+ employees, ostensibly these groups would probably have a health plan or some kind of benefit plan, and they have more than 100 employees, so there's a good chance that they would have more than 100 participants and would likely have to file a 5500 form. The total 5500 forms filed for groups with 100 or more employees was 3,900. So clearly, they know that most employers are not satisfying the requirements and probably don't have an SPD. The total number of 5500 forms filed was only 50,000. Next slide. There was an increase in the fines, and most statutory fines actually have inflation and increases built into them, and the Department of Labor is no different. But it seems kind of interesting that a failure to provide an SPC goes up from 1,000 to 1,087. The failure to provide information requested goes from 100 to 147, and then the failure to file a 5500 goes from $1,100 to $2,000 a day. That's an 87% increase. Next slide. In the budget request that they recently submitted, this is their areas of concern, and what I find interesting out of it is that vigorous enforcement is number 1, and strong consumer outreach is number 5, and effective participant assistance and outstanding customer service is number 6. So I think they're telling everyone pretty clearly where they plan to spend their time and effort. There was a change in the regulations in January, this last June actually, and effective January 1 of 2019, all plans, regardless of size, are going to be required to file a 5500. So even if you have literally have a mom and pop shop with 2 employees, you're going to have to file a 5500, and you're going to have an SPD, summary plan description. They are also creating a new form of Schedule J just to make sure that the plan sponsors or fiduciaries are handing out all of those documents, all of those notices that were in the earlier slide. There's no statute of limitations on 5500 form filing. So as soon as they uncover that you haven't filed, they're going to ask you for the prior years. So I will tell you, just referring back to the benefit summary again, there are probably a good number of dealerships that have plans that require an SPD and a 5500 form filing. So if you are one of them, I would highly recommend that you get in touch with an accountant to determine whether or not you need to file those forms, and then get your plan into compliance. If you had a reimbursement or an HRA program, file the 720 when you file your tax returns, and then figure out what you need to do for your 5500 form. And again, going back to the SPD, if you haven't properly documented your plan, I'd highly recommend you get started doing that now. And whether or not you determine you need to file back to the date of inception or when you first offered a plan is up to you. But at this juncture, if you do it now before 2019, it seems highly unlikely that they'd ask you to provide multiple years of back data or multiple years of back SPDs for your plan, as long as you had the one in 2017 or 2018 prior to their requiring it in 2019. One of the firms that the equipment dealers has contracted with is a company by the name of Total Administration Service Corporation. They are one of the largest third-party administrators to handle documentation. But more importantly than that, they actually provide an audit guarantee, and they will actually help you in the event of an audit. Go through that audit, make sure you have all the documents. They also help you manage and maintain the documents so that they're all current. If you've determined that you need to file or create an SPD and file 5500s, again, call us. Our contact information is going to be on the next slide, and then we can get you set up with tasks to get their ERISA program in place. And now I'll throw it out to any questions, Alex.
We do have one question, if I can get my mouse to move. The question is this necessary for a business that has less than 50 employees? Are there guidelines around the number of employees the business must have to comply with these regulations?
Yes. For now, a business that has fewer than 100 employees doesn't have to file unless they have a self-funded plan. And again, keep in mind that an HRA or any type of reimbursement program, if you pay anyone's deductible or co-insurance or co-payments as an employer, then you have a self-funded plan. So even if you have fewer than 100, you could have 2. You would be required to file a 5500 form.
I actually had a question looking at this from earlier in the presentation about the 5500 form filing. You mentioned that we needed, I guess currently 100 people, 100 participants. Does that include spouses or other dependents that you might have on the plan?
No, it just includes the employees.
Just employees. Okay. Are there any other questions from our webinar participants for Bill? All right, if not, we'll go ahead and turn it over to Mike and Dennis from Scheffel Boyle.
Well, thanks, Natalie. This is Dennis. Mike and I are with Scheffel Boyle. We're a CPA firm with approximately 120 employees. We're located in Illinois, in the St. Louis, Missouri metropolitan area. We service people nationally. We're part of the alliance firm of BDO. We've got many clients in the ag and construction industry. Myself, I also operate a farm. We raise corn and soybeans, and you wouldn't need to call myself a farmer. The farm's 10 acres, it's multiple acres. So we are involved and understand the industry. We're going to go through fringe benefits, talk a little bit about LIFO, state taxes, 179, and some other deductions. First question we normally get out on fringe benefits: why do you want them? The goals are to be competitive in the marketplace and hopefully have a satisfied, productive workforce. What type of fringe benefits we're going to cover? We're going to cover some health benefits. I believe, according to the survey, 91% of you provide health insurance. Retirement plans, 84% of you have some sort of retirement plan. Expense reimbursements, we'll get into some items on, and achievement awards. Also in the survey, we've got listed on EDA survey some other potential fringe benefits that you can look at. We'll first go through cafeteria plans. If for any reason you have any of your employees paying any part of their health insurance, whether it's for themselves or their families, you probably should have a code section 125 or cafeteria plan. It can have health insurance, disability, unreimbursed medical expenses. That may be referred to as by some of your employees as a use it or lose it plan. Now there's a $500 carry forward if they have dollars in their unreimbursed medical expense plan that they can carry forward to the next year. Dependent daycare is also part of the cafeteria plan that you might want to consider. It would give your employees potentially a better tax break than they can get on their own individual return. How does it benefit the employers? You might be saving some payroll taxes and having happier employees. First off, we'll talk about health insurance. There's really two different types of health insurance according to the tax code, those that qualify for an HSA account or a health savings account and other health plans. If you have more than 50 employees, you're already concerned about health benefits through Obamacare and or the Affordable Care Act. An HSA, first off, is a health savings account that allows your employees the ability to put pre-tax contributions into a plan for their qualified medical expenses. It is not a use it or use it plan. It's one that carries over each year for the employees. According to the EDA report, it looks like only about 23% of you utilize an HSA, but then there was other parts in it that said maybe about 40% of you contribute. So a small percentage of you do utilize an HSA. Another type of health benefit is an HRA. That is a health reimbursement arrangement. Normally, the employer would fund that, and it's normally a portion of the deductible. There's also something out there that many of you might be looking into. If you had less than 50 employees, you want to look into what's called a small business HRA. That would allow businesses with less than potentially 50 employees to reimburse their employees for their individual health insurance as long as they don't offer a group health plan.
Dennis, I'm going to interrupt you real briefly. It looks like a couple of folks have been raising their hands, I think possibly in an attempt to ask a question. For those of you who'd like to ask a question, it should be at the top left of your screen. There's a little Q&A button. If you press that button and type in your question, we'll get it and we'll answer it at the end of Scheffel Boyle's presentation. Thanks.
I guess I'm back up. I'll try to talk a little bit about disability insurance. It looked like approximately 51% of you offer a long-term disability and 65% of you offer short-term disability. What I want you to know really about disability is if the employer pays for the disability premium or your employees put it through a cafeteria plan, basically it's taxable income if they ever get disability insurance benefits. If the employee pays after tax, basically then if an employee becomes disabled, the benefits would be non-taxable. And that's something I want your employees to understand. Then on the next slide, we have on some of these fringe benefits, there may be not all employees eligible. Certain highly compensated employees may be exempt from certain fringe benefits. Partners or more than 2% shareholders on S Corps are prohibited from many fringe benefits. So you want to make sure if you're that type of entity, make sure you understand the rules and communicate with your accountant. Going to retirement plans. And again, I'm hitting this pretty quick. We've got probably more detail on these slides to where you can look at them. But normally whenever I think of retirement plans, I think of qualified plans. Defined contribution plans, and I want you to think about that as you put in a defined amount each year for your employees, and from that, whatever they have at their retirement is what they get. A defined benefit plan, on the other hand, I want you to consider that as if you're guaranteeing a person a benefit, a certain dollar amount for a certain period of time, maybe for life. And that type of plan's not really that popular today in the for-profit entities. We see that more in governmental. The other type of plans out there are non-qualified. We won't get into them much today. You might hear them referred to as like phantom stock plans, certain type of employment agreements. It's normally a method to provide a benefit to a select group of employees. I'll start with some defined contribution plans, and really, we'll talk a little bit about SEPs, simple 401k, and profit sharing plans. First off is the SEP IRA. It's really not a defined benefit plan, but it's very close. It's probably the easiest to establish and administer. it's relatively very cost effective to get one established from an administrative standpoint. The rules on the eligibility of eligible employees, you have to cover a lot of employees in a SEP IRA. You must cover those that's indicated, all except those that are indicated on this slide, but you can be more generous with eligibility, but you can't discriminate. In a SEP IRA, you can contribute up to 25% of compensation. However, the maximum contribution cannot exceed $53,000. The contributions are 100% vested immediately. Some of the SEP IRA advantages: easy and inexpensive to establish. Contributions are discretionary. Disadvantages: the employer funds 100% of the employee's retirement. Contributions immediately 100% vested. Next, I'll go into a simple IRA, and I guess it gets its term simple because it's easier than a 401k or other type plans. Again, relatively simple to administer. The eligible employees are listed below. Again, you have to cover many of your employees with a simple IRA. The simple IRA, I want you to think of it as a plan that you can defer, the employee can defer up to $12,500 per year. And if they're over age 50, they may defer another $3,000. That's $15,500 the employee can put in. The employer basically has to make either a non-elective contribution of 2% or make a matching contribution between 1% and 3%. So there are employer contributions required. Again, advantages for the simple plan: it's easy and inexpensive to establish and maintain. The disadvantages of the simple plan: the employer contributions are immediately vested, and there's limits on the amounts that can be contributed when compared to other plans such as the 401k. And I believe there's a significant number of you who have simple plans but maybe it looked about in the 10% range. In the 401k plans, and that's the most popular plan with, according to the EDA survey, about 2/3 to 3/4 of you offer 401k plans. Those plans take a little bit more to get them designed. Most people would have a prototype plan. There are reporting requirements. The eligible employees, you can become a little bit more restrictive than you can under the simple or the SEP. Normally you would have 21 years old and 1 year of service, generally a $1,000 requirement. In a 401k plan, the employee can defer up to $18,000 per year, and if over age 50, an additional $6,000. So the employee can significantly contribute to their own retirement plan up to $24,000. There is discrimination testing in a 401k plan, and that's basically in case you have highly compensated employees, they could be limited to the amount they can contribute and make the 401k plan a little bit less effective. The vesting schedule, I want you to understand a vesting schedule can help hopefully retain some of your employees. And many times we'll see a vesting schedule of up to 5 years. Then based on the discrimination testing of a 401k plan, if you believe you might have concerns with that, there's what's called a safe harbor 401k plan. Philosophically, you want to take a look at whether that's a better plan for you than just the regular 401k plan. However, in the safe harbor plan, you basically have a 3% non-elective match or up to a 4% basic match. Again, there's notice requirements, all those things. The slides are available. It's more information than I can get into today. Why the 401k? For the safe harbor, it avoids the discrimination test. for the deferral, that you can exclude some part-time seasonal employees. You got higher deferral limits for your employees. The employees fund most of their contributions. The disadvantage, it's a little bit more costly to maintain than the simple IRA or the SEP. Another way to effectively put more into a plan is to match up a profit sharing plan with a 401k. And that's really an effective way to get up to $53,000 into a plan. It combines advantages of both plans and be part of a single document. A profit sharing plan, normally we'd see people either have a prototype plan or you can have an individually designed plan. There's more cost to establish a profit sharing plan, but you can have a little bit more flexibility. Again, there's eligible employees. Normally it's 1 year of service and 1,000 hours. The contributions can be discretionary for the profit sharing plan by the employer, and it might allow for some non-uniform allocation. We'll get into that a little bit, here pretty quick. Well, actually real quick, it's the next slide. If you wanted to try to provide additional benefits to some of your highly compensated, you might want to integrate your plan with the Social Security. Or there's cross-tested plans. Those are plans that if you're trying to benefit potentially some of your highly compensated employees or certain groups that you believe are exceeding goals. So I want you to understand that there are those two type of plans out there. So on retirement plans, advantages, on the profit sharing, you can target certain groups. You might be able to exclude some part-time people, and some disadvantages of those type plans. They're more costly to maintain administratively wise, maybe not dollar wise, and the employees don't contribute if it's the profit sharing plan. The 401k plan and the simple ones they do. So deciding which plan's right for you, you need to sit down and try to understand what your goal is. Who are you trying to maximize the benefits for? How are you trying to reward your employees, your budget considerations, and always remember, flexibility may make it a little bit more complex. Complexity may create a little bit more cost of administration, but it's worth looking into. Talk briefly about expense reimbursements. There's two types of plans. It's another fringe benefits. One's an accountable plan, where the employee must provide support of whatever business-related expenses they have, and then the employees, those payments to the employees are excludable from wages. The employee benefits, the employer would benefit by that by having potentially less payroll taxes, workman's comp, insurance, and retirement. The non-accountable plan, if the employee, if you give somebody, say, $500 a month, they don't turn in any expenses, that's just included in wages. Next, we'll talk about achievement awards. Achievement award is something you should look into if you give any awards for any of your employees based on length of service or safety and safety awards. You can give them up to $1,600, not in cash, but in some sort of an award without having it taxable to them on their W-2. You want to look into that if you have any type of awards. Next up, I wanted to talk briefly in regard to inventory. I know that's not part of your employee package, but the LIFO inventory method is probably something all of you should be considering. It defers taxes, and I've got an example. Whenever you get into the EDA's item, and I'll go through it briefly. LIFO is something that I believe every dealership should look into. I know if I owned a profitable dealership, I would have been on LIFO for quite a number of years. That doesn't mean if I'm not, that I wouldn't get on it immediately. Something everybody should be concerned about. In this example, I'm just taking inflation at 2.5% per year. Use the 3.5% interest rate on your cost of money. Combined federal and state rates 35%. If your starting inventory today is $10 million, in 20 years, your $10 million of inventory would have a cost of approximately $16 million. If you're in LIFO, I guess if you're on FIFO, you're going to be considering your inventory value for tax purposes at $16 million. If you're on LIFO, you might have it valued at $10 million. That can save and defer taxes of about $2.25 million over that period of time, and the interest on that saved tax dollars can be $750,000 or about $3 million. So it's significant, and we just wanted to bring that to your attention here today. On LIFO, the advantages, again, deferred taxes, save interest cost on borrowed money. So some people say, well, why with all those advantages, what about, what are some disadvantages? Some people think the disadvantages, and I guess right now we're having problems getting that on our slide. So try to hang on a second. I don't know if EDA can help us.
People have trouble viewing.
Which slide are you guys having trouble with?
Not clicking through.
We're not clicking through on the disadvantage.
Do you see them now?
No, we don't. You're also required to use it for financial statements. There's no lower cost or market. I know some of you like to get in, and if you used equipment, especially in the last couple of years, have devalued, you cannot make a lower cost or market adjustment. You have to stay on cost. And it is a little bit more complicated, but it's significantly worth the effort. Sometimes on the financial statements, whenever you get there, you have to make sure your bankers and your lenders understand it. So a couple questions we normally get to. Can you move it, Natalie, for us, or Alex? You know, some people would ask us, if I went to LIFO, do I physically have to sell the last piece of equipment first? And how do I keep track of it? Well, that answer is no. You would normally, your accountant would probably set you up on what's called a dollar value pool, so you don't keep track of that each thing. Can I combine, another question is, can I combine LIFO with writing down to market certain items? And that's an absolute no. That would terminate your LIFO election. Others might want to use LIFO for tax so they can have the tax advantage, and then cost for financial statements will look better to the banker. Can you do that? And again, that's an absolute not. It would terminate your LIFO election. It's not too complicated. Everyone should be looking into it, and we go from there. Go ahead.
Okay. This is Mike Fitzgerald. I'm going to go ahead and start on the state and local income tax. We figured since it's tax season, we would spend a little bit of time at least talking about this, just so people are aware. A couple of comments to make on this. We're located, as Dennis had indicated earlier, in Southern Illinois, right across from Missouri. You know, as a general rule, whatever state you're located in, you really need to understand the tax implications of the state and local for whatever state you're in, or whatever bordering states that you're next to that you might have some type of relation with. So we're going to talk a little bit in regard to payroll taxes, sales tax, and then income tax. I will say that the term that they use that states are looking for is they're looking for any type of nexus. And nexus is really a relationship or association with those states. And so they definitely are looking to generate as much as they can in the way of state and local income tax. So let's take a look at the very first one. It's payroll taxes. And it's on the slide. It says, you know, the questions you need to ask are, where does the employee live and where does the employee work? Again, in Illinois, we have reciprocal agreements with Iowa, Indiana, and Kentucky. And so if you live in Illinois but work in one of those states, they will take out Illinois withholding. We also border, obviously, Missouri, and we do not have a reciprocal agreement with Missouri. So people who live in Illinois and work in the St. Louis area, they have Missouri taxes withheld. So you just need to be aware of what those rules are. Again, talk to your CPA to help you determine what those rules are. Second issue we have is on sales tax. Again, they're going to look at nexus. What relationship do you have with the bordering states or with your state? One, they will look to see if you are sending salespeople into those bordering states, or are you sending mechanics into those bordering states? They also look to see, are you using your trucks and your trailers to haul the equipment to the farmers or whatever in the bordering states? All of those situations can create nexus. And again, states are getting very, very aggressive when it comes to sales tax and income tax. So they will be looking at those types of relationships. In the state of Illinois, they don't even charge sales tax on farming equipment. They do charge it, obviously, if there's any contractors out there with contracting equipment. You know, the state will go after, the state of Illinois will go after that with sales tax. So again, you need to understand what those rules are for your state. In regard to income tax, again, nexus is important. Obviously, if you are filing payroll returns in bordering states, if you are filing sales tax returns in bordering states, those states most definitely will look for you to be filing an income tax return. Now, there are different ways to apportion income. Each state has really its own rule. There is like a three-part apportionment factor. They will look at payroll, they'll look at sales, and they'll look at how much equipment or inventory you have in those other states, those bordering states. Some states are just single apportionment. So those states just truly look at sales. They'll look at total sales, and then they'll look at the sales within that bordering state, and you'll have to allocate that percentage of your income to that state and pay income tax on it. So that's a general overview. Again, the basic rule is you just need to understand what your state's rules are and those bordering states near you if you truly have people who are salespeople going in, mechanics going in, or if you're delivering into those states. Next slide. I guess next slide then we'll get into the bonus depreciation in 179. Start off with bonus depreciation. The PATH Act, which was a tax act that was enacted in 2015, you can see from the slide that the bonus depreciation was 50%, and the thing you have to remember is that bonus depreciation is only applicable to new equipment. It does not apply to used purchases. So for 2015 through 2017, you get to write off 50% of that cost of that new equipment in year one, and then the remaining 50% you would depreciate over its remaining life. After 2017, that 50% starts being reduced. It goes down to 40% in 18, it goes down to 30% in 2019, and after 2019, bonus depreciation, as the law exists today, will no longer be around. It will be expired. So if you need a little push to get your farmer to buy a new combine or something before the end of the year, you might use bonus depreciation and let that farmer know that they acquired it in 17. You get a 50% write-off. If they don't get it until 18, they're only going to get that 40% write-off. Okay, next slide. So Code Section 179, expensing election. Again, the 179 has been around for a number of years. It started off at like 2,500. It went up to 10,000. It went to 25,000, and it has grown over the years. It currently is $500,000. The tough thing about the 179 going back a couple of years ago is that Congress would never get the laws enacted until around the end of the year. I think one of the years they actually waited until January and then made it retroactive back to the previous year. So it makes it difficult for farmers and for construction people to figure out how much equipment they're going to be able to write off or whether they should make purchases. So the PATH Act did make the 179 permanent. It is at $500,000. It will be indexed for future years. The nice thing about the 179 is that you can use it on either new or used equipment. So either new or used, you can expense up to $500,000. If you acquire more than $2 million worth of equipment in any year, that will start phasing out the ability to deduct the 500, dollar for dollar, so that by the time you get to 2.5 million, you will have phased out any benefit of being able to claim any part of that $500,000 deduction. Now, the good news is the 2 million has been indexed for 2016, so actually it's up to $2,010,000. And again, every year that is supposed to be indexed. Okay, next slide. This is just a real brief overview. I have a lot of clients asking about the current status of income tax laws, and this has got, what I have on these slides is the current law, President Trump's proposals that he made during the campaign, and then also the GOP has put out some proposals that they would like to see for tax changes that are going to take place. I guess the first comment I would bet or state is that Congress had always said, President Trump had said, that before we could do anything on the income tax changes, we had to repeal the Affordable Care Act. We had to get the new health care system in place so that they knew what the effect on the budget was going to be. Well, after last week's debacle with the Affordable Care Act, they've now backed off of the Affordable Care Act and getting that replaced. Now they're going back to income tax planning. So I'm not sure how they're doing that if they don't know the effect of the health industry on the budget, but that's what they've decided they're going to do. As you look on the first slide, this is for C corporations. In the current law, there's brackets that range from 15% all the way up to 35%. By the time you're at 75,000, you're up into the 34% bracket. President Trump has proposed that on the C corporations that it be a flat 15% tax. Again, that's on the income retained in the business. There's been really no clarity on what exactly or how that's going to work, but that's what the proposal is. The GOP proposal is that 20% tax be on the C corporations. The flow-through entities are the next slide. Is the current law is that S corporations, LLCs, and partnerships, the income from those entities flows through and you pay for that at your individual level up to a 39.6% bracket. President Trump's proposal is that that be a flat 15% tax. The GOP proposal is that that be a flat 25% tax. A lot of people out there talking, how is this going to work? You know, if I take wages, I could be taxed as high, even under President Trump's proposal, the rates would be as high as 33. So if I take salary, it's at 33. If I leave it as a flow-through entity, I only get 15. So there's a lot of questions on how this is going to work. It'll be interesting to see what they finally come up with. Next slide, please. These are business deductions. Again, current law says that businesses can deduct all ordinary and necessary business expenses. Under President Trump's proposal, he is going to eliminate a number of deductions as well as eliminate a number of credits. Actually, I believe under his proposal, the only credit that would be left was the R&D credit. That's the research and development credit. Not many dealerships are dealing with R&D, but who knows? But again, he talks about doing away with that as well as doing away with some deductions. The GOP proposal, one thing that you dealers might like is that they're talking about no more depreciation, no more spreading that out over a 5-year or 7-year time frame, that if you buy an asset, that you get the immediate write-off all in 1 year. So this is even better than the 50% bonus depreciation or better than the 179. There's no limits, no anything. But again, they also are going to limit, because they're bringing the rates down, they have to limit some kind of deductions. So under the GOP, they're talking about only interest expense to the extent that you have interest income. It also eliminates the domestic production deduction, which a lot of farmers take advantage of. So farmers just need to be aware that that might change. And then the last slide I have is in regard to net operating losses. Current law says if you end up with a net operating loss, you can carry that loss back 2 years and free up some tax dollars and get a refund, or you can carry it forward for 20 years. President Trump's proposal it's not been touched. The GOP proposal, I thought this was an interesting idea. They're going to do away with the carry back, but they're talking about only allowing a carry forward, but for an indefinite time frame. And then what they're talking about is adding some type of a cost of living or an interest factor to that carry forward, so that if you had a net operating loss in 2016 and you didn't get to use it until 2020 when you had some profits that you could use the loss against, they're talking about increasing that loss by some type of a cost of living adjustment over that 5-year time frame. And so that if your loss started off being $500,000, by the time you got down the road, it might be $520,000 or $525,000. Kind of an interesting idea, but again, none of these I don't think we can bet on. It's going to have to go start obviously in the House, then has to go through the Senate, then President Trump would have to approve it. So there's a lot of work to get done. The only thing I guess I would say as a closing comment is, at least it looks like they're talking about tax reform and the reduction of taxes. So one thing that we tell our clients and that we try to sit down and do year-end planning with is, when you have a situation where the taxes are going to go down, you really need to think about postponing income, deferring income, and accelerating your deductions. Bring the deductions into the high years where it's a 35% tax. Try to defer income into those years where you might only have a 15% tax. That's the end of what I have. I don't know if there are any questions. Oh, it looks like there's some questions.
I think some of the questions had to do, we were having a little bit of technical issues at the beginning. And then there's also a question in relation to LIFO inventory related to parts, and what's the implications if your equipment manufacturer, the software program, keeps your inventory using an average cost instead of, and how does that compute into LIFO? And basically, if the average cost should represent your, actual cost, theoretically, there could be some minor problems. I don't believe it would be a significant issue under LIFO if you were examined. There could be some minor adjustments to your inventory if the IRS determined that the average cost was an actual cost. And then you would have to, most inventories on LIFO, you're going to, I'll say, double extend a representative sample and try to create an index. And that index with those cost factors are used to determine your index and your LIFO reserve on that. So it's maybe not the best, but I don't believe it's a significant issue. It should not terminate your LIFO election. Like if you tried adjusting, and this is one thing you cannot do, is some dealers might say, well, I've got some parts inventory that's say 3 years old. My likelihood of selling them is low. I want to write those down significantly to market. You cannot do that. That would terminate your LIFO election. If you're going to write down your old parts, you need to throw them away. Or you have to take them into account on your LIFO computation. Hopefully I answered that question.
Is there any other questions for Mike and Dennis? If not, we'll go ahead and wrap up for the day. I want to give a quick reminder. Next month, April, EDA is doing a webinar with Machinery Pete, Greg Peterson, so stay tuned for some information on that. And then related to today's presentation, our June webinar will be with Caroline McNary from TASC, the organization Bill referenced earlier. She's going to discuss more detail on ERISA and ACA compliance. If you have any questions for EDA or our presenters, please get in touch. Again, all the slides and the recording from today's presentation will be available. You'll get an email when those are ready. And with that, just thank you guys all for your participation today. We appreciate it.
Thank you.
Thank you.